Basically, the corporate finance course, just put it down here, has got two disciplines, right? So the key thing that we need to actually, start off with is that key two disciplines that you really need to be comfortable with. The first one is you have financial accounting.
Okay.
So this is the first discipline, and this discipline, the target audience is or users, let's say, because you've got people that are ultimately going to have to use the financial statements. Will be people like let's just put the brackets here, lenders, and these are the people that would want to assess whether you can afford to repay the loan. Because if I'm going to lend you money, one of the things that I'm worried about is whether you'll be able to repay the loan, right? So, and then the other user that would be interested is government, because obviously they collect taxes from the companies. So they would want to know that, you are preparing the financial statements that they can rely on, and they will collect what is due to them. And then the other user will be a potential investor. Okay. Potential investor to say, can I invest in this company? Will it be around next year or the next couple of years? Because if it's not going to be, then what will be the point of you parking your money in a company? So what you would ideally do is to pick up a set of annual financial statements and then go through them and say, listen, year on year, this company has been doing great. In comparison to its peers in the same industry, they are actually doing okay. So therefore, I'm comfortable to put my money into this company. And the other user that can also be interested is potential employees. Because if, let's say, for example, I'm now looking for a job, I need to obviously do some assessment to say, if I'm joining the longest company, am I comfortable that it will actually carry on, doing what it's doing in the next, few years to come? Because I don't want to get employed in a company and then tomorrow be told, listen, we're liquidating, and therefore everybody has to go home. So that's basically why potential employees are also, the users of financial statements. And then the other thing that I want to just highlight, because now we are still under discipline one. Yes. So the outcome of this discipline is financial statements, or what we usually refer to as annual financial statements, AFS. Yeah. Statements. And you will see that this is usually prepared by people that are obviously qualified as accountants, and that will be Chartered Accountants of South Africa. Yeah. And then they use, for the guideline, they use International Financial Reporting Standards, which is IFRS. Yes. Yeah. And this is basically the framework. So basically, you can look at this as a reporting framework. Yeah. So everything that they do is guided by the International Financial Reporting Standards to say, this is basically how we account for revenue, cost of sales, and all the rest of the other things that you find in the annual financial statements. So you are likely going to be given this annual financial statements in the exam itself, right? And your role will be to do an analysis, because the idea of this the qualification is not really to turn you into a chartered accountant, but the idea is to say, even what the chartered accountant would have done, are you able to perform some analysis and make a certain decision, depending on what you actually find to be the case when you are assessing the financial statement. So basically, the first discipline is financial accounting. They are target users, and it's actually externally focused. And I think the one key word we need to actually then put here is this discipline over here is actually externally focused.
Okay.
The users are not in the company itself. They are outsiders wanting to do an assessment about the performance of the company. And one of the reasons why they are interested in evaluating the performance of the company is because, look at lenders, for example. These guys would be people that give the company money in the form of loans to say, okay, guys, here is money, go run the business and pay us interest together with our capital. And by the way, the one user that we don't want to actually forget here is shareholders.
Yes.
Shareholders are the people that will obviously entrust the directors with resources to say, listen, we are buying the share certificate in this company, go around the company, and at the end of the day, if you make some profit, then you can distribute some of them in the form of dividends, right? So that is basically why we would be interested to know how the company is doing. So
Yeah.
in the main, you'll then see that these are actually the people that are not necessarily within the company, but they're still interested in the affairs of the company. Now, the second discipline number 2, then this is actually the management and accounting side of things. Manage account. So these guys are actually, this discipline, it's actually internally focused. Contrary to the first one, this one is actually looking from within. Internally focused, and it is ideally meant to aid internal decision making. Decision making. At some point, this course was called decision making. But now corporate finance is actually now the name that is being used. And it's mainly to say, when we are internally focused, what is the outcome as opposed to annual financial statements there? Now we're just changing a few things here. What is the outcome? It's not annual financial statement. It's going to be management accounts.
Okay.
And then contrary to what the accountants are using as international financial reporting standards, everything that we do here is informed by business logic. There are no set of accounting standards that we are actually using. And obviously, our target audience, as I indicated, is actually management itself. So they are professional bodies for financial accountants who are CASAs. Maybe let's just put that here so that then it makes perfect sense to you. So the professional body here will be SAICA, for example, South African Institute of Chartered Accountants. And then this one here, it will be CIMA, Chartered Institute of Management Accountants. And this is obviously a South African professional body. So this is SA. It's SA. And then these guys over here, they're actually sitting in the UK. And you'll soon realize that these guys are highly regarded because you are actually a global financial or business leader, because the qualification that you can come out with here is actually what they call AGMA. It's actually a global chartered management accountant, AGMA. So this is basically the designation. If you do CIMA curriculum, you're going to come out as an AGMA, but if you obviously follow the financial accounting route, you're going to then obviously become a CASA as a professional designation. So this is essentially where we always start these discussions, because when you know exactly what informs what, you are likely going to find it easy to relate to everything that I'm going to say at a later stage. So now we're going to go through those two disciplines individually and see exactly how do they actually then put together these annual financial statements, as I said, following the international financial reporting standards to help. I think what we don't need to lose focus of is the fact that we are actually doing these financial statements to then help those people to make decisions, about the affairs of the entity. Lenders will be deciding whether they want to give you more money in the form of loans. Government wants to determine whether you're going to pay the right taxes. Potential investors will be obviously determining how much dividends you're supposed to be paying them, or even decide whether they are going to invest money with you. Potential employees to seek employment, and then obviously shareholders are the people that will obviously be making, essentially the investor and the shareholder. These are actually pretty much the same thing, because when you're investing in the company, you become a shareholder. So this, we can actually look at them as basically the same thing. It's just that obviously we use different names here. But here down here, when it comes to management accounting, we're basically saying there's management that has to run the show. They have to make internal decisions before they can obviously go and report to outsiders. So this is basically now, these two disciplines are fused into this qualification or discipline called corporate finance. So when you're talking corporate finance, you always need to check whether you're wearing the financial accounting hat or are you wearing the management accounting hat, because that will guide you what principles are you supposed to basically be using. And later on, when you're going to be doing questions, even with the guys on Saturday, we're going to have to ask ourselves, are we wearing our financial accounting hat or are we wearing our management accounting hat? Because that then helps us in terms of what to focus on in terms of what we are trying to solution for. So it's very important that we always constantly ask that question, because it actually helps to say, are you following a business logic or are you following the international financial reporting standards to actually then put together a set of numbers? Now let's start with number one. So this is basically, I'll just name this background to say basically what is happening in terms of the course itself. So now we go into the first discipline, which is the financial account. So we actually go through this step by step so that we can actually cover what we need to cover. So in terms of the financial accounting, because remember we said the intended outcome is annual financial statements. Yeah.
Yes.
So the question is, what is the first statement that you need to actually go through? It's what we call SPLOC. Don't worry, SPLOC is just the new name for the income statement. And I want you to liken the income statement to the pay slip of an individual, because it's only when we try and look at this thing from our personal perspective that it's not actually making sense. So accounting is not supposed to be really boring. It's supposed to actually, make sense to you. And if it doesn't, then we need to stop and ask the question as to whether, do we understand what we're doing? So you can look at this income statement as the pay slip of a company. For a company, we don't necessarily obviously have a pay slip, but that is the equivalent really of a pay slip, but it's just that it's in the context of a company. So I just don't want you to lose sight of what we're trying to do here, because it's very important that we sort of relate this to real life situations. So the first thing that you usually will find in the income statement is revenue. Sometimes this thing is called sales, and then sometimes it's called turnover. And it's very important that we go through all this terminology, because in the exam itself, they can actually use these words interchangeably. And the last thing you want is to be confused to say, what are we now talking about if we are now talking about sales? And then the next time we then mention, it's pretty much the same thing. It's just these are synonyms.
Okay.
Do you have a question so far?
No, so far. I understand how you give in also different terms and all that. I'm following.
Yeah, perfect. Great stuff. So now let's jump straight into what then follows cost of, this sales. The next thing that we then need to deduct is the cost of sales. This is the next line item in the income statement. So basically, yes. So then let's put numbers to this thing so that then later we can do some number crunching as well. Let's say we raise R1 million. We do so well, we raise R1 million. I'm just going to put these things as an answer so that they can obviously be clearer to you. Cost of sales. So now we obviously need to spend some money to make money. So let's say we spend 40,000, and that's basically where we are. Now, we then need to say we made R1 million. Before we could make that, we had to go in and get cost to the tune of, the 340,000. The question is, what is your gross profit? So your gross profit will basically be 660. This is the gross profit.
Okay.
So gross profit, all done. So if this is the case, then we're now going to take out operating expenses. Now let's assume our operating expenses. Of course, let's just mention examples here. This will be water and lights, and electricity. Electricity, the one that we're always going to have these days. Salaries. Yeah, salaries, or sometimes employee benefits. And this is a big expenditure line item. We will have things like stationery, for example, printing stuff, buying pens for employees and all the rest of the other things. Maybe there's telephone and telex. Okay. We'll obviously have a whole host of other things to actually pay for here, but for now, let's just limit this to just examples. And then let's say you would then have paid water and electricity, say the 10,000 for the whole year. You could actually, maybe you have a solar, you don't actually need to pay a lot of money. The salaries is basically going to be the bulk of your expenses here. Let's put it on 20,000. Of course, this can be millions, but we just, for the purpose of keeping this simple, that's what we're doing. And then stationery usually is a small amount, 1.5. Just need to make it negative so that it can show that it's actually an expenditure. And then here, let's say you're big on phones, calling customers and doing all sorts of things. And then now we then need to add all of this together and say, okay, what is the total sum of all our expenses? And then you would see that we've had to pay 134,500, for example. That will be profit for interest and tax, PBIT.
Okay.
Or sometimes it's called EBIT.
Okay.
Earnings before interest and tax. Sometimes it's called operating profit. Why am I mentioning all of these things? Because I don't want you to actually then get different terminology in the exam and you'll be like, but what is this now? So then basically it's just to say that we've made a gross profit of 660,000. We've had to pay expenses to the tune of 134,500. And therefore, what are we left with? Then we're going to take that number and then obviously minus that number. After paying all these costs, we're now left with what? 525,500. Yeah. Then because the first thing that we haven't deducted here is interest, and then obviously this will be finance cost. Yeah. Finance cost. By the way, this is just another name for interest. Yeah. And that's basically, let's say, for example, we have a loan and then ABSA charges us whatever, let's make it 2,500. That's the interest for the whole year. Because remember, we always report for 12 months, yeah? And then now that you have interest taken off from this thing is going to come back, but as profit before tax now. Or earnings before tax, because the I is gone.
Yes.
Right? So that's basically how then you obviously then going to have an amount here, and that will just be that plus that number. So basically we're now, after paying the loan, the interest on the loans that we have is 2,500. We're left with 533,000. By the way, the other way to look at this thing, just to make sense of it, right, is to basically say, what is this operating profit here? So I'm just going to make the subheadings to be in bold so that later on when I actually did say, let's focus on this, you understand why specifically we're focusing on different line items. So these are the sort of the main headings in bold here. And the reason why this is the case, because the finance cost of the interest is actually an indication of the fact that we have a loan, but that loan is not sitting in the income statement itself. The fruit or the cost associated with the loan is what is sitting in the income statement, right? And then the one thing that I also just want to highlight now is the fact that these things, as you go down here, the operating profit, this line, the way to look at it, right? This green line is basically to say this is the money we've made before we paid anyone outside our operations. Because look at this thing. That's why this thing is called operating profit. In other words, profit from operations. Paying water and electricity is your day-to-day activity. Salaries, monthly expenditures. Stationery, what you incur from time to time. Telephone, say. Now, when you're saying this is an operating profit, essentially what you are saying to remember our target is to tell these people what happened in our business. Those people over here, we are saying, guys, you've given me money. I've run the business for the past 12 months from our operations before we paid anyone outside. And remember, finance cost is associated with a loan. A loan is usually from a bank, and banker is an outsider. But look here, he's one of the users as a lender. Do you see that there?
Yeah.
So this information that we're preparing here, we are actually intending to provide it to those people to then be able to make an evaluation about the performance of our operation. So this is where we start. So if you were to actually get a discussion question to say, basically, how would you explain the profit before tax and interest? Is basically the profit or the money you've made before you paid anybody outside your normal day-to-day activities. So, but then when you start paying, interest, then obviously you've paid the first external user, which is the banker, and then you get profit before tax. Then the next thing that you're going to then have to do is to deduct tax. Let's say your tax here, remember these are just estimates now.
Yes.
4,000, right? A tax to the tune of 4,000 rand. What is left in the kitty? It's going to be that number, 519,000. And we call this profit after tax or PAT. Sometimes we call it EAT, earnings after tax, and basically or net profit. So this is the money that we've made when we've paid everybody else, and we are left with, this is like equivalent to your net salary, if you like. This. Okay. Remember, I said you must liken the income statement to your pay slip as an employee. Yes. So that will actually start making sense for you if you actually look at it that way. And the reason why you have to do that is because at the end of the day, you really need to see this flow to say, you can say the revenue therefore is gross salary in the context of an individual. And then obviously there are deductions like medical aid deductions and all the rest of the other things. And therefore the operating, the gross profit is basically what is going to come to you before you start paying school fees and all the other things. And then obviously then if you have loans, then they will take off whatever that you need to pay. So this is basically no different to your personal space. It's just that an income statement is like the pay slip of a company. And we say is one of the first set of reports to then come up with a set of annual financial statements. So the first thing is the income statement. That's basically how it actually flows. Now, from the perspective of the users, remember we said the CASAs will prepare these things. So then the user will come in and say, okay, fine. If I was to see what is the gross profit percentage, remember this is the rent value figures that we have here. So from an analysis perspective, you might want to start doing some interesting, analysis. And then that will be what we call a ratio analysis. The first one that you will actually calculate here, maybe let's then put this there and say ratio here. So remember now the users have to come in and do some analysis. This guys over here will come and do some analysis. They will come in here and say, okay, give us the set of numbers that you've put together as a performance indicator for the company. And then they'll come in and say, okay, what is the gross profit percentage? Then that means you take that number, you divide it by sales. And the reason why you divided it by sale is because you are actually saying, no, this is actually supposed to be in store here. And we're saying this is the GP percentage, as the name of the ratio is the gross profit percentage, right? And we're saying how you calculate it is basically by taking the gross profit as an amount divided by revenue. Then we are saying that out of basically now the story behind this was 66, because this is going to be in percentage, is going to be 66%, right? So what we're saying is out of every 1 rand, remember this is always going to be 100%. Why? Because it's the base, it's a top line number. So this 66% is basically telling us that out of every 1 rand that we made in terms of sales or turnover, we had to pay 66 cents. I mean, so we've made 66 cents out of every 1 rand. Remember, that means then we would have paid some 34% in costs. So out of every 1 rand, we've made 66 cents, right? So in other words, we must have then paid that number there. And how you can easily get that is going to be that number minus that number. So in other words, basically what you're saying is, this is what you had to pay to generate 66 cents out of every 1 rand that you've generated from revenue. Does this make sense?
Yes, yes.
Because this is actually going to be very, very important going forward. And I just want to do this so that it can actually reflect that it is a cost. Therefore, it's see what it does. It's complaining about -1 multiplied by -1. So I just want to actually do this as like that number, obviously minus that number. That's basically what we're expecting. Let's just check. It's complaining about the formula. So basically what I'm trying to do here is for you later on when you practice, you need to see the flow of numbers. I just want to make sure that it makes sense here. So you would have actually paid 34% here, yeah?
Yeah.
Before you can actually, earn your 66 cents, because 100 minus 34, that's how you get to your 66 day.
Yes.
So out of every $1, you had to pay 34%, and that's how you get to 66%. Now, this number is very, very important. That's why it's the first subheading. Why? Because what you're going to start doing is how much did I actually generate from my revenue after paying this cost last year. So you're doing year-on-year comparison to say, have you improved this, or have you actually gotten to a place where your performance has actually dropped? Because this is the evaluation that these guys, these users, potential investors, government, lenders will be looking at these ratios to say, are we improving? And therefore, especially these guys, these shareholders here, they're looking to see whether you are increasing this. Because if you're increasing the profit generation capacity, essentially you're going to have enough money to pay in the form of dividends. Because remember, them giving you the money, they are interested in how much dividends you're going to pay, and you can only pay dividends right at the bottom here. So if you are actually increasing that, that will cascade down to the number, the amount of dividends that you can ultimately pay. So they analyzing this to say, how did we do, let's say previous year here, yeah? So in the previous year, how much was this? If this was some 55%, then we are super excited to say, we are actually growing. Look at that.
Yeah.
Out of every R1 last year, we were only able to make 55 cents. Now, out of every R1 that we made this year, we were able to generate 66 cents. In other words, we're taking care of what? The only way to increase this is to drop that. Yeah. So in other words, we're closely monitoring what we spend money on. Maybe we say being on delivery cost that is part of the cost of sale, such that we drop in the cost that is associated with us being able to make a sale. And therefore, that's where we're able to move from 55 to 66 over there. So that is where you start. And not only will you do that, then how about you then say, how are the peers in the industry doing? If they're sitting on 44%, then you know that you're actually doing great, because you were actually beating them even last year. Now, not only are you beating them, you're beating your own target now, and then you are actually doing great. And therefore, this is exactly the kind of assessment, because remember, these guys are going to be looking for this set of annual financial statements. We are saying that the first report we're putting together is the income statement, and this is the kind of analysis that they will actually be engaging in. So we're going through this so that you can see exactly how the whole thing works.
Yes.
Now, there's no ratio that you can do with operating expenses. You can do year-on-year comparison to say, if you now in total for all operating reasons, you spend 134,500. If you're spending, let's say now you've spent, let's say this is 2022, right? You've spent this in 2022. 134. Your interest will be to say, how much did I spend last year? If you've spent, let's say 120,000, now you need to explain, how did we get to 134? Are we growing? And what is the reason why we're growing? Is it because we're employing more people and therefore our salaries have gone up? And that's basically what justifies the jump from 100,000 to 134,500. So you're going to do, an analysis at that level, but there's not really a ratio that you can actually do just using operating expenses itself. Yeah. Now, let's get to this one. The next subheading there is operating profit. So this is where you will actually be saying, what is the operating profit margin? This is what they call op margin, yeah? Operating margin or operating percentage. So in other words, out of every R1, remember the revenue is always a base. That's where we start. Out of every R1 in sales that we've made, how much did we actually generate as our operating profit over here? So what you're then going to do is to say, okay, fine. If I've made 525,500, then I need to divide that by 1 million rand. That will give me some 52 cents. 52 cents or 53 cents, essentially, if you convert this to a percentage. You see, so you've out of every R1 that you've made in revenue, now you've generated 53 cents, which is not bad. Right? Because it cost money. So obviously you're saying that you've had to pay for all of this before you generated that. And now you just do an assessment as to basically out of every R1 that I've made, how much have I actually generated as, an operating profit. Now, here's an interesting one. Interest cover, is this the ratio that, you as an internal user will use? No, it will mainly be the banks that are saying, what is the interest cover of this company? The interest cover is basically just to say how many times are you able to cover interest from your operating profit? In other words, how many 2,500s do we have in there before? So this is the ratio that the bank will use to say, should I give this person a loan or this company a loan or not? So your interest cover is you're going to take then, your operating profit itself, divide by the interest itself. So this is basically, so why is it minus? Oh, because this is actually minus. The negative number, it's actually supposed, let's just multiply this by 1 minus 1 just to make it a positive. But the reason why it's actually throwing out a negative number is because we've minused it there. So but it doesn't really change the rationale. The thinking here, why is it? Oh, this thing keeps on saying. Okay, so let's put it there. Perfect. So what does this number mean? It means you are able to cover your interest 210 times. And the higher the number, the better from a bank's perspective, because then they are actually doing what they call credibility checks or credit checks to say, it's like when somebody wants to give you a loan, one of the things they will ask for is usually going to be, your pay slip and your list of expenses that you actually, you are showing that you're incurring an expenditure on different line items. So they would want to know, what exactly do you spend your money on? Can we actually give you, an additional credit? Because if you're already overcommitted, so they wouldn't want to risk giving you additional amount because you might actually struggle to repay the money at the end of the day. So this is what the bank does from a business perspective, to say, if a company approaches us and saying, listen, here is our set of numbers, wouldn't you have a look and decide as to whether you can grant us a loan or not? The interest cover is one of the ratios that they will definitely make use of. And this is basically the rationale or the thinking really behind the interest cover calculation. And you will actually basically see that they are saying the higher the number, the better, because then you are demonstrating your ability to be able to repay the interest together with the capital back to the banker. So that is basically what they would do, right? So that's the number 210. You are able to cover 210 times your interest from the money generating from your operations before you pay government. Do you see that government, what tax goes to? This is government. Actually in brackets, government here. That's why we then mentioned when we started that they are also interested
yes,
as a user. Tells them how much tax they can actually collect from. So that's basically the ratio you can calculate. Now when you come down here, you are then going to say, okay, I can do what we call the net profit percentage, or what they call net profit margin. So this is the net profit margin. It actually then tells you, now ultimately, when you are actually done paying everybody else, you've paid government, what are you left with in your pocket? This is what I then equated to your net salary earlier, to say what you are looking at here is to say, out of this 1 million rand that you've actually generated, you've had to pay direct costs to get you to be able to sell. The reason why this is called a direct cost is because it costs money for you to make some. Directly linked to you making the money, you must go and spend some. And then you pay these things to run the show. You are left with that before you pay the bankers. And then you pay the financial institutions, you're only left with 523. You pay the government, then you are left with 519,000. So this is what sometimes is referred to, by the way, as the bottom line. In financial articles, you hear that this is actually called the bottom line. Yeah?
Okay.
So in other words, this is what is left right at the end, right?
Okay.
This is not in the financial or an accounting term. It's just the lingo that gets used by the financial, analysts.
Okay.
Now, this is basically what is left when you are done paying everybody. Now, the question is, how much percentage-wise have you actually made? You remember, everything is as a result of dividing that number by sales. Yes. Okay. Then you've basically made 52 cents out of every 1 rand that we've generated from sales. So not bad. So, yeah. But you then need to, whether this is bad or not bad, you need to compare this to what you did last year compared to what your peers are doing. Then you can actually then make an overall conclusion to say you are actually in a better position or things are worsening, and obviously take corrective decision, because we must not forget the reason why we're doing what we're doing is because we want to enable these users over here to make decisions. So if things are obviously worsening here, you can see that we're on some 80%, now you're dropping to 52%. It might mean that there's a lot of sound here. You're not taking control in terms of managing your expenses. This is basically how you will then actually use this number as a way to analyze your performance. So it's very important that we just don't look at this as a number. We're actually calculating this to aid the decision-making process, but it's just that this time the target audience is obviously outsiders, but we're helping them to make meaningful, decisions or economic decisions in terms of what they're seeing as the performance of the company. Okay. So remember to then obviously go back and compare this to how you did last year. If it was 45% and your peers are doing, let's say 75%, then you're in trouble. You're beating your own target, but not quite your peers. You see what I'm saying? So before you can actually make that conclusion whether you are really doing great or not, you really need to be thinking, am I doing great against what? You need to have sort of a benchmark. So that benchmark is either going to be your own, year-on-year performance, or it can actually be the comparison with your peers. So you always have to look at both, because you don't want to be excited to say, hey, I'm actually doing great. But you need to then ask the next question to say, against what are you comparing your performance? Is it year-on-year performance? In other words, you're beating your own prior year target or outcome, or are you actually then, comparing this to your peers or counterparts in the industry? And I think if you're doing well against your own target but not against your peers, then you really need to look deeper into the problem areas to say, what have we spent last year in terms of these different line items, and focus on where you can shave off some of the costs, then to up this, because this is, let me just change a number here and you'll see how interesting this number is. So if you change your salary, let's say for example, maybe because of COVID you've had to let people go, and now you're no longer paying 120,000 and you are rather paying, let's say, 100,000, for example. Yeah, say you've paid 100,000, then you see how this actually improves slightly. From 52 to 54%. So it is an indication that if you're not doing so great here, then there might be a lot of noise here that you might need to then, as a manager, have to go back and take a corrective decision in terms of, what can you save on going forward, such that then the bottom line, as the analysts would refer to this number as, improves year on year, also more importantly against your peers. So in the exam itself, you're going to be given this number for the peers of the company that you're analyzing. Because remember, your focus will be to analyze the target company that is under review. But what the examiner would then do is to give you the related target performance or the industry performance to then be able to say, listen, I think we're doing great, or we're just actually not anywhere close to how the industry is doing performance-wise. So this is really the first statement that you'd come across. Now, this is where your your exam is going to come from. There are only two critical decisions that you can make once you have reached this point of 539,000, and that is what I call a doctor decision. And you will hear me say this like several times.
Okay.
A doctor decision basically is just to say, now that you've made this money, do you distribute some or do you retain the rest of the money? So this is now a dividend policy that will then come into play, where the shareholders will sit around the table and say, guys, what is our investment philosophy in this company? Are we making this money to be able to make our shareholders happy, or are we wanting to retain it for future profitable projects? Because it's basically going to boil down to that. So as an investor here, your role is to then analyze the philosophy of the company you are about to invest in, to see whether they've been paying dividends in the past few years, so that then you can align that investment philosophy with what they are actually doing in terms of operations. Because the one thing you don't want to do is to be frustrated later to say, I didn't know that you guys don't actually pay dividends, but you rather want to keep the money for future profitable projects. I wouldn't have invested in this company. So your role, that's why we're actually looking at these guys as potential investors. In other words, they have not invested as yet, but they'll run through these numbers and then year-on-year comparison against the peers to say MTN versus Vodacom, for example, because you have to get companies in the same industry, like in the telcos. You then obviously be comparing Cell C, MTN, and Vodacom to say which of these telco companies actually pays dividends. And I'll give you a classical example as to what we need to do that. Because if you're an elderly person, for example, right, you obviously would want to leave off your investment. You've actually accumulated wealth over the years that you've been working. Now you've got this million saved up. So what you're really wanting to do is to invest in a company where their philosophy will be to make sure that once they've made the money, they pay a greater portion of that money in dividends. But if you have a company that is still young and growing, they would want to keep the most of the money to then invest in future profitable projects. So that is essentially the income statement in a nutshell. But there's a lot of things that can actually come from here in the form of the question. And later on, when we're going to be doing question, I'll be saying, listen, Douglas, this is exactly now the relationship back to the income statement. Because now we've just dealt with the first, report. We're now going to say, what is number two? So at the back of your mind, you need to understand that this SPLOCI, which is the statement of profit or loss and other comprehensive income, is what we generally use to call income statement. And the guys that are, part of the accounting standard setting board felt that income statement is not sexy enough. They came up with this complicated name of SPLOCI. But at the back of your mind is an income statement. It's simply the pay slip of the company, and we will call this statement number one. Statement one. Okay. Then now we're moving on to statement number two, which is down here. Statement number two is basically what we call SORCE, which is the statement of changes in equity. So this is basically to say, assuming that you're not starting out now, you've been running this company for the past couple of, years. So you will have opening balances. In other words, the reserves that are coming from the prior years, coming into this current year now, in terms of what you've generated in the past as, your revenue. So this is how the statement of changes in equity will look like. You'll have headings here that says, this is the share capital. Share capital will be the money that we have raised from the members of the public by, issuing share certificates, and then retained earnings. In other words, the money that you've made, over the years that you've been running this business, and you haven't distributed in the form of dividends. But for the previous years, remember we said you've been running this thing, you can actually be able to do year-on-year comparison. The money that you have been distributed will then sit there, but then you'll have an opening balance here.
Okay.
Yeah. So this opening balance, let's say, for example, we have 100,000, and then we've got retained earnings. This is the money that we've amassed over the years that we've actually been running the business. Let's say is 500,000. Now, what is going to happen is during the year. So remember, this is like a movement, just like your salary. You end your salary in August. You didn't spend it all. Let's say, for example, when you're starting in September, you had 500,000 in your account, and then now you've run this business net profit, or this number here comes in. It doesn't actually go there. It goes under that number. So this number is actually going to be that number as a top up. But then you're saying, okay, you know what? We've got people that have given us money, and we call those people shareholders.
Yes.
To make them happy, we will obviously have to pay some in the form of dividends. And obviously that is going to then drop this amount. Let's assume you've paid, what shall we call this? We've got 539. We can easily pay 139,000 in the form of dividends. And so now the question is, what is left as a closing balance? Yeah. So closing balance would then be balance. Basically, then that will be okay. Let's take this thing. Closing balance will then obviously just be that number. Now you've made some money. You started with that. You've made that amount of money, but then you've had to pay 139,000. So you should be left with some 900,000.
Okay.
Yes,
okay.
And that's exactly so, because all of this is 1,039,000, but then you had to actually then pay 139,000 as dividends, and therefore you're only left with 900,000. So this is basically the flow of these numbers. And again, what I want you to realize here is this is obviously going to lead to the third statement, because these things are interlinked. And that's a relationship that I want you to start picking up, to say, we've actually started with the statement number 1 over here. Then we made this 539,000, and this 539,000 is going to knit into almost, we might need to actually do that so that then you can see the cross check to say the money you've made lands in the statement of changes in equity. If you have not issued shares during the year to actually raise capital, then this will be zero all the way. But then now we are still having shareholders to the tune of 100,000 there. So then statement number 3 then, just moving this along, you're basically going to say, okay, what is statement number 3? This is going to be called statement of financial position. Let me just do the statement of financial position, or what we previously called a balance sheet. So basically, the balance sheet is based on the accounting equation, which says assets equals to owner's equity plus liabilities. So this basically, in simple terms, is the genesis of accounting. If you don't understand this accounting equation, then nothing will make sense even later. So this is very, very important, because what it says is assets equals to owner's equity plus liabilities. But in simple terms, what it says is before you run a business, you need resources, and those are the assets. Yeah. Yes. You need buildings, you need motor vehicle or delivery buckets to do deliveries and all the rest of the other things. You need furniture, you need computers. All of that collectively will give them a name called an asset. Yeah. Now, how do we then end up with the assets? Some of them will bring them in a personal capacity. I mean, think about this thing this way. You say, for example, you currently don't own a business, but you have a Toyota Hilux Bakkie that you're using for private use. And then you decide, you know what, this business of me going to work, I'm going to die poor. I really want to go and start a business. Then you say, okay, from now on, I'm going to register this Toyota Hilux of mine, as a delivery vehicle in the name of the business. Then it's no longer your business in your private capacity. I mean, your Bakkie in your private capacity, but rather a company asset. So now it's going to sit in the asset space, but the question is, how does it lend into the business? You brought it in, owner's equity. that then makes you to actually then have an equity in the business, because the delivery vehicle, the Toyota Hilux, is now the company asset. It's sitting there, but it's also going to represent your share in terms of how you bring assets into the business. And then some of them, the assets that you're going to get, you go to Absa and say, Absa, listen, I need a building. I have a delivery vehicle, but I need an office to operate from, but I don't have the money to buy the office. Wouldn't you lend me R1 million? And then obviously I'll pay it back, of course, with interest. They will charge you interest there. Do you see why they're interested as the users of the annual financial statements? That is why, because now they are then going to have to give you the loan to then enable you to buy the building. This side will have a building, right? If you're buying it outright, that is also a possibility. But this side will have a loan. So basically what you are saying is the sum total of what you have as resources is as a result of some of them that you have brought them in, and some of them you went and borrowed money from external parties to then buy the same assets. So this thing has to balance all the time. Yeah. Because what you actually have as resources is as a result of what you brought in and what you actually then went and borrowed money to, buy from the financial institutions mostly. So you can see that this is a horizontal representation. It's actually going sideways. But then what this thing is doing in terms of the balance sheet is just converting this accounting equation in a vertical format. You can almost say this is actually taking this accounting equation to face down. So now let's put a symbol there just to remind you later when we're looking at this to say, what are we doing in terms of the balance sheet? We're just actually taking this accounting equation and making it to actually face down. And then we're going to start off with assets, because that's the first thing that we have here. Assets. We're just going to further categorize them in the form of non-current assets. And then we'll call this property, plant, and equipment, for example. And then when we are done with that, we'll then say another type of an asset is current assets. Yeah. Current, let me just write this out. Current assets. And then in here, the easy way to remember this, my brother, is just to say, use this abbreviation, IDC. What do I mean by IDC? IDC, the first one here will then be inventory. Let's just go here. Inventory, or what we previously called stock. The stuff that you haven't sold. Yeah. And then the D here will stand for debtors. So the people that you sell to on credit. And then this one over here, the C, will that be cash and cash equivalent. And this is basically the money in your bank balance and short-term investments that you can easily terminate. The reason why we bring them in here, the 32-day notice, is because they are near cash. In other words, you can easily cash them in and obviously be able to pay your short-term obligations as they become due. But what I want you to realize here is, actually, let me write this out completely. Non-current. In other words, these are things that you can use for long term, like you're building delivery vehicle. But all of this, I want you to realize that this and that, they are members of the same family. They are all what? Assets. Yeah. And therefore, let's put amounts here. Let's put amounts here. My screen is frozen. Just give me a second. Okay, there we go. So PPE, let's say property, plant, and equipment, it gets to be at the end. Yeah. Or let's use maybe 1, 2. It's different. Perfect. So we've got 120,000 sitting as property, plant, and equipment, and we've got this as 30,000 people that owe you, 20,000 there. You're so lucky to have 150,000 sitting in your account. So all of this are members of the same family, and therefore we will then add them up here and say this is equal to the sum of all of these things here, right? And then that is 182,000. So then down here we'll have total assets. Yeah. So this total assets will then basically be that number. Actually, let's use that number plus this number over here, because we are saying that this is basically the only number, therefore, it's basically 120,000 against non-current assets. So these in total, so this whole thing here up to there, we basically are saying that this is assets. That's the A in terms of this. So we're going to give it a color. Let's make it bold. We'll say, what color shall we give it? So the things you have, that's the A. So that's the A on this equation over there.
Okay.
Bold, and then we'll make it that. Right. So that's basically the relationship there. So this whole, we're just breaking it down, but then making it face down. Yeah. And then we're going to go here because this thing says owner's equity plus liabilities. We do exactly that. We say equity plus liabilities. Yeah. And then we start off with equity. So we're then saying equity. What is our equity? And remember, we said we had a statement of changes in equity.
Yeah.
So meaning that this is the number that actually comprises of share capital and retained earnings, and then we'll have a total column. Usually it's going to be a total column here. And then we will say whatever that we have here is the sum total of that number plus that number. And then we just drag this all the way down, and then we get the total just like we did here. And that will then be the total amount of money that we have as, you know, owner's equity. So this plus that minus that must give us that. But that is as a result of that number plus that number. It gives us $1 million. Yes. You see how it works?
Yes.
Exactly. So this number over here, so let's give it a different color. Let's say it's red. We shouldn't use it. Let's use this. We need a different color there. That number there is what we're going to bring down here. Okay, the screen is frozen. Just give me a second. Okay. Can you still hear me though? Okay.
Yeah,
perfect.
I can hear you. I can hear you.
Yeah, it's moving. So that equity number, remember we're going to say here share capital. Yeah. Share capital. And then we're going to have retained earnings. Now, this is basically going to be the share capital here. And then the retained earnings is going to be that number over there. But these are members of the same family, and therefore box them, and then equals to the sum of this two. Yeah. So that then becomes R1 million, and this is the color we gave to
equity.
That day. That's the total equity. Yes. So now, then we're saying, okay, fine, we've got liabilities. Remember, this is just the E. This is, so this E over here, let's give it a different color. So that we are matchmaking right now.
Yeah.
So that is that E, and where are we here? This is this two here.
Yeah.
Owner's equity. This is that number there. Okay. So now we are continuing, and therefore we need to then bring in liabilities. That will then be, we just better categorizing this to say you'll have non-current liabilities, and examples of that will be long-term loans. Long-term loans. We will also have things like debentures and all the rest of the other, debt instruments that you can get there. Now, once you have this, let's say we have 200,000 there. We've borrowed from the debenture holders 300,000. Okay. So now that is going to be members of the same family. That will then give us total there. 500,000 came from the long-term liabilities, and then we come down here and say, but we also have current liabilities to run the shop. This would be things like your bank overdraft.
Okay.
Banks and the famous trade creditors. Trade creditors. Okay, so the trade creditors Now, this will obviously have their own amounts. Let's say we're going to have a lot of, debt, debt in the form of bank overdraft, trade creditors is 15,000, let's say. This over here is actually going to be score equals to sum of this two. Perfect. Then we've got 35,000 here. So, but this, sorry, not that color. We're not doing that color. We just want to bold that. So these are the liabilities, right? These are the liabilities, and let's go and find them a color that is suitable for them. And then, because this it's money going out, let's give them an orange color.
Yeah. Just
to add meaning to the stuff. So that's that number. So all these numbers that are here now, will then add. So then you know that this is what represents the L there. Now we are saying that this total equities, and abilities. So now that will then be that number. It's one. Equity in total, do you see that? A million. Yes. Plus, that is a liability. That is also a liability. So we are sitting on 1,535,000. But what is the problem with our numbers? They don't balance. Why? Because the asset base is very small. We're going to fix that up now, and we're going to go up here and say, okay, fine, remember, this is the money that we got. This is, by the way, we got some money from equity and then liabilities, and we used it to buy this assets. Therefore, whatever that we actually bought here must be equivalent to the money that we bought. So let's go fix up this part here. Let's bump up some assets here. We can easily say the following. What is the difference? Let's go 135. This is what we called creative accounting back at school, but we're doing this to balance the numbers so that then it makes sense what we're doing here. So let's go and say PPE, because it's usually your infrastructure. It's going to actually be something that is massive. 1, 2, 3, 3, because it's buildings and all the rest of the other things. 1, 2, 3, 3, 1, 2, 3. Yeah. Perfect. Now our total assets is obviously where it's supposed to be, and we are good to go. And basically, this is what the examiner is going to give you. But what I wanted you to realize is all of this is basically E. And let's go down here. All of this too is basically your liabilities. Yeah. So now we gave these things colors. Let's go back and see what colors you can give them. They are just here. So this is green. The equity is green, but now the assets. What is the color of the assets? We need to change this. We need to change that. Assets. Let's give it maybe that. Have purple. Let's try and see. Let's use that. Okay, so that's the A. So this is this A here. This E over here. What did we give it? It's green. So we're going to, light green. Then we're gonna go there. Go this one. And go there. Let's make it bold. And then this L here is basically going to be, what did we say? Orange.
Orange. Yes.
So let's go there and say that, do that and just make it bold. So basically, this is what I wanted to basically get to. Now that we are here, remember, we did all these nice things here where we are analyzing these ratios and all the rest of the other things. Equally, when you get to that statement, remember, this is statement number 3. This is 3. We need to realize that this leads to there. And then we now have this statement, we must be able to do some calculations or ratio analysis, because these guys are the ones that are going to say, we've entrusted you with money to run the business. How did you do? And they then report back. That's why it's accounting, your ability to account to someone that has given you resources. So that's essentially where accounting comes from. So, and if you get it from there, to understand exactly why we're doing what we're doing in terms of, the analysis and the logic of accounting, because I often find that once students understand what is the genesis of accounting, even when we do ratios later, it's pretty much straightforward, and it's something that people actually appreciate. Now, let's see what ratios can we actually do here. Because we've got assets here, PPE, we can calculate what we call return on assets, ROA. Okay. Right? So basically, you're just going to take, this is actually going to be operating profit divided by assets. So basically, that's what you can do. What ratio can you calculate here? Then there's going to be things like your inventory days. And this is what Douglas, I need to tell you about ratios. You don't need to go back to read a textbook. The secret is in the name. If it's inventory days, you know that they're obviously, you're looking for days, you know that there are 365 days. But the first thing in the ratio itself is inventory. So the numerator is going to be inventory, then divide by. Now the question is, what do you divide by? And again, you don't need a textbook for this. You can logically figure it out, because how did you end up with stock in your storeroom? You went and bought it. And the cost of buying that stock, we call it what? The cost of sales. Because the stock is what is it costs you because you want to sell it. So it's the cost of sales. That exactly. Yes. So you don't need a textbook for this. But because you're looking for days, then you multiply by 365 divided. That's it. And then we're saying there's a second formula here, or ratio that you can do. What is that? Inventory turnover. And inventory turnover is the opposite of inventory days. So therefore, it's going to be cost of sales, then divide by inventory. But then this one, remember, is time. So in other words, how fast are the items leaving your shelves? Inventory turn. So you take your cost of sales divided by inventory, and then you ultimately then get a number. So you would want that number to be higher, especially if you're selling perishable goods. Because if you're selling things like yogurts and people are not buying them as fast as you would wish them to, they're going to rot, and then obviously then it means inventory write-downs, and it will affect those losses. They will definitely affect your bottom line here, because then you're going to have inventory losses coming here as the noise or part of the expenses. So you don't want that. So what you're saying is, I will do some calculation to see how fast am I selling the stuff. Now, there's a caveat to that. And that is the nature of the products that you're selling is very important. If you're selling those big machines like your Caterpillars that you find next to OR Tambo, I mean, those things, if you sell 3 of them, you're fine. You're set for the whole year. But then if you're selling like your perishable stuff in the FMCG space, the fast-moving consumer goods, you really want those things to fly off the shelves. So this number, you would want, so in other words, what am I saying? A grade inventory 10 for one company is not necessarily going to be great for the other company, because it depends on the nature of the products or services that we are rendering. If it's those big machines that have a long lifespan, fine. A lower inventory turn is okay, because if you sell few of those things, you are still okay. But if you are in the perishable space, then you are in trouble. You really need to get this number year on year to be higher, and also compared to your peers. So this is now. And I hope and pray that you are now seeing that we are building a story around the numbers. It's not just the set of numbers that we actually spewing out. You're actually going to start saying, what does this number really mean? Or what can I do with this number? Now, within debtors, you can do what we call debtor days. And again, because it says debtor, you're going to actually use the numerator as the debtors. Divide by, and now think about it. How did we end up with people owing us? Because we sold to them on what? Credit. Therefore, credit sales. But because we're looking for days, we multiply by 365, then divided by 1. So, and now this, my brother, I want you to take a special note of this number over here. We need to give it a color. So you see this credit sale over here?
Yes.
Okay, so let's give it something that is unique.
Yeah.
Red is already here.
Maybe green. No, sorry. Okay. It's that yellow, yeah. No, it's not. Okay, yeah.
We used a couple of these. I really want to use something that is standing out, man. Yeah.
Maybe more colors.
Maybe let's do that. Let's do that. Let's see. Where will we find more colors here? Green. Let's add this and see if we can be given a wider option. Nothing comes up with sales as that.
Maybe the first rate.
Oh, the first rate. Let's do that. Yeah, no, that stands out. Yeah, perfect.
Okay.
Okay, so this number here, you must link it back to this number over there. That.
Okay.
Because what this million rand means is actually a cocktail of cash and credit sales. So this is to say, as you and I are on this call, people are at Woolies, for example, right?
Yeah,
Some of them are swiping their debit cards and therefore instant cash into Woolies bank account. Some of them are using the Woolworths credit cards, the ones that they got from the. So, but at the end of the day, the accountant, these guys are here, this guy's here. When they looking at this line, they saying this is cash.
Yeah. Okay.
This is cash, and so this is not cash. This is revenue. Whether you paid cash or credit, we all considering the
revenue.
That number as revenue. So holistically, so in the exam, my brother, they're going to give you this 1 million rand, and then the examiner will sneak something in and say 60% of the revenue is on credit. So when you come down here to do your data days, you're not going to take the whole 1 million rand and plug it here as a denominator. You're going to say, okay, now then it means here I will need to say, for example, in the context of our example, we're going to say 1 million rand. 1 million multiplied by 60%, because you only want to deal with, you can only say somebody's a debtor if they bought from you on credit. You see where I'm going with this?
Yes.
So in the exam, you have to make sure that whatever number that you're going to actually regard as credit sale is either informed by a percentage in the scenario itself, or if there's no percentage that is given to you, then you can use the 1 million rand, but you need to then tell the examiner that you've assumed that 100% of the sales is on credit, because no split was indicated to you as to which portion is actually, on credit.
Okay.
So just make sure that you are very clear in terms of putting together, these assumptions. And these are the assumptions that gets to be used in an exam to say, if no portion of the credit sale has been indicated in the scenario, the assumption is the 100% of the revenue was actually on credit, and therefore it can be used to then calculate the debtor days ratio. Does it make sense?
Yes.
Perfect. Right. So what I'm saying is you must go look out for a percentage as to how much of this revenue here is actually on credit, because a person is a debtor if they bought it from you on credit. So it will be irritating for somebody that bought on cash and you phoning them to say, hey, when are you paying me? Imagine sending a statement to somebody that has swapped their debit card. They'll say, but are you nuts? When did I buy from you? So which is why you can't necessarily say this is debtors divided by sales. It has to be credit, because you're acknowledging that these are the people that have actually bought from you on credit. And you need to look out for what percentage of the revenue as it's given to you here in total as a million is actually on credit. And let's move on to cash. Cash, there's no ratio that you can actually calculate here. No ratio.
Okay.
However, what you need to do, check the size of the balance. Remember, if you have cash in your bank balance, do you really earn interest on that? No. So if you are dealing with a wise accountant who's managing your books, year on year, you'll say, okay, fine. Last year we had R1 million when we closed our books in our bank account because somebody had sued us and we're going to pay whatever legal cost that we need to pay. But this year we don't have that similar situation. Why do we have so much money sitting in the bank account? Because that is not prudent. In other words, it's not wise to be keeping a huge amount of money in the bank account because you're not earning any interest. You can easily say, let me keep enough just to keep me going, but then the rest of the money need to go to some investment products so that you then don't lose out on an opportunity to earn interest. And that's essentially what we call in economics an opportunity cost. Unless if there's a justification for this 150,000, we must keep this at minimal because we earn close to nothing in the bank account. Yeah.
Okay.
So there's no specifically a ratio that you can calculate on that. Now, on the equity side, here you can easily calculate what we call return on equity. So return on equity is actually going to be PAT, profit after tax, divided by equity itself. And it's a percentage. So why profit after tax? In other words, what is left? What is left at the bottom? So that is why the shareholders, these guys over here, they're very concerned to see how you're performing in between here, because they're the last ones to be paid after paying the bank and the government. So if you're not doing so great here, there'll be nothing left here. And these guys, they know that they will get nothing, which is why when you get to this bottom line, you have to make a doctor decision. Do you distribute in the form of dividends or do you retain? So these guys that are giving you the money to run the business, they want to see how you run this show, because if nothing is left, they get in nothing. And this is exactly why we're saying there's a return on the equity holders. In other words, they gave you the money. They want to see basically what percentage are you actually generating from the use of the resources they gave you. So here, what you can calculate as a ratio for the loans, you can calculate debt to equity ratio. We can calculate what we call leverage. Yeah. So now we're building a story to say what kind of analysis can we actually do here, and then coming down here is creditor days. There's nothing that you can do on the bank overdraft except to just watch it to say you don't want to actually be having a lot of like a huge balance in the form of a bank overdraft that is used to finance your operations, because that doesn't show that you are actually liquid. Because the one thing that I want you to start realizing is we have to build a relationship between these two. This current liabilities, let's go here. Current liabilities, maybe we need to give them the same color. Current liabilities and current assets. This two here needs to start having some sort of linkage in terms of what we're building here. Let's get something lighter, beige like that. So this two, because we are saying from our current assets, we need to sell our inventory, collect the money quickly, make sure that we have some in the bank to be able to pay our trade creditors and the bank overdraft. So there's a close relationship between that and that. And by the way, we call that what? A working capital, but in management accounting. In financial accounting, we just say there's a relationship between current assets and our current liabilities. And then, exactly. And then we're going to then say, holistically, therefore, we have to calculate what we call acid test ratio. So acid test ratio, because it's going to combine current assets and current liabilities, we can't put it against any line here. It's over and above what we've done so far. Then we'll say, okay, there's another ratio we can calculate and we call it the current ratio. And what is the current ratio? It's looking at the relationship between current assets divided by current liabilities. Now let's understand what this is actually saying. Do you have enough short-term resources to settle your short-term obligations as they become due? That is the story behind the current ratio. Yeah.
Okay.
Now you have this situation here where there is a norm or industry norm. So you have to check in the industry that you are in. If you are in the telco space, what is the norm? Usually this will be 2:1. But then now we need to understand, what does this 2:1 actually tell us? What does it mean in simple terms? Yeah. So let me just quickly get it to actually show. see what it does, this thing. Okay, so, or is a format. Let me just change the format here. Format cells. I'm just gonna no man. I'm just looking for 2:1 in simple terms. Don't bring me stuff. And it say 2:01. It's putting this as a time. Let me just change it. A special, no, let me just say not date, accounting, currency, general. This is so strange, man. Okay, let me go custom. I just, I don't want any decimal.
Yeah, okay.
I just want to delete that. I just want it to be a number. Okay. See? Okay. So if I say 3 is to, oh, looks like it might work. 2:1. Let's see. Pump it out. What? Want you to do, but it's not doing that. Okay, let me just check something. I'm going to have to format this. I didn't think that it would actually be such an issue, but now it is.
Maybe if you do copy paste in the same cell, I'm just thinking maybe there's other formulas, then maybe it might kill it.
Yeah, no, that's very true. Just copy this across to. You know what? I'm going to type this in a Word document somewhere, cut and paste it here. I don't have time to be sorting out the formulas because I really just want us to get correct. So basically, but whilst we're sorting that out, the idea here is 2:1 in the form of current ratio basically says to us, oops, okay, you know what? Just assume that, let me just see, I can put a dash this. It's making Nash's voice. Okay, assume that this is not 2:01, it's 2:1. There's no 0 here. Okay, so the good thing is we are recording this, you can actually always go back. So basically what this means is for every R1 in current liabilities you have, you at least have what? R2 in assets.
Yeah.
So you see that you are actually in a better space. So what you'll be doing is to calculate. Remember, this is the industry norm. This is what the industry which you are operating in is saying, that every company to say they're in a comfortable position from a current ratio perspective, they must actually at least be sitting on 2:1. But if you find a situation where it's 0.8, in your case, is to 1, what does this mean? This thing. This formatting is not working for us, is it?
Okay, just do like, you see a comma in the cell, put the comma first, and then you can punch in.
Oh, okay,
like
maybe
a
then,
comma,
okay.
A comma.
Yeah, 8
Actually,
is to.
No, sorry, not a comma, sorry, and what's a semicolon? No, a colon actually. Open a cell with a colon. A colon. No, that's a comma.
Yeah. Let's say maybe 0.8, right? Is to 1. Let's see. Yes, I think this works. Okay. So this, what does this mean? 0.8.
Yeah.
Like that is to 1. It means, let's actually remove this. Yeah, let's make it 0.8 is to 1. What does this mean? We are actually 20 cents short to pay every R1 in current liabilities that we have. This is a bad situation. So we were not able to meet our short-term obligations as they become due.
So meaning this company can easily close down.
Exactly. And this is the assessment that these guys will be making to say, a current ratio of this company is doing so badly, but now you need to write this big fat note. No one ratio tells the full story. You don't just analyze the current ratio and then conclude based on that on the overall performance of the company, because a company's performance is defined by multiple things, and it is for that reason that we're going to do a whole host of ratios and then overall conclude, which is why we're doing ratios in the balance sheet now. We did ratios in the income statement, and then we'll then, get these things to talk to each other and then decide based on overall performance analysis as to whether this is a good or bad company. You cannot necessarily just say based on this income statement that is actually not looking great in terms of the peers, but it's actually improving year on year, and therefore this is a bad company. You need to then say, out of all the ratios that I've analyzed, are the majority of them in a good or bad space? Then you conclude based on overall performance, because remember, you are analyzing the company in its entirety as a potential investor, as government, as a lender, to then make a decision as to whether you're going to make a decision to invest in them or lend them money. So it's never a one-sided story. Yeah. That's very, very important. Now, then in addition to that, there's this thing called acid test ratio. So acid test ratio says, because your current assets include stock, and before you can say you are able to settle, because remember, we are saying here, current ratio is our ability to settle our current liabilities from our current assets as they become due. But remember, with inventory, you still need to go and sell the inventory. Therefore, we say it's actually slow moving. So we minus inventory from our current assets. You see what we're doing? Because we're saying acid. You see, if you pour acid on a cloth, it immediately turns into something. How quickly can we actually then be able to convert these things to cash? But let's take out inventory because it's slow moving. The rest we can actually be able to convert because we can forward a debtor to say, hey, you must pay. Because remember, in our current assets, what sits in our current assets is IGC. But we have stock. Stock needs to go out because it's slow moving. We want to see what is our ability to actually settle our short-term obligations as they become due from the readily available sort of cash or liquid resources. Whereas we're doing what we call liquidity ratios here. How liquid are we to settle our short-term obligations? And as you can imagine, if already this current ratio, which includes stock in it here, because in the current assets here, we have stock, but we don't have inventory here. Yeah. So you expect this to be some 0.6% is to 1, because already, if it was bad at that level, it's actually going to be worse here. Because now you've even minused, you've made your current current assets to be lower. So you expect, if the current ratio is already below the norm, you expect the acid test ratio to be worse. By the way, another name for acid test ratio is called a quick ratio.
Okay.
How quickly? And this is actually, that's why hence I'm saying the secret is always in the name of the ratios. You don't need to, I'm not looking at any textbook, and these guys that I was with the other day, they were like, but Joseph, how do you remember all of these things? It is because you look closely into what this thing is actually trying to achieve, and then you relate it to what you're trying to actually do here. And you'll find that the norm usually is to say 1 is to 1. What does this mean? It means that for every 1 rand in current liabilities that you owe, at least have a rand to cater for it. So here you are 40 cents short to settle your current current liabilities as they become due. So you are definitely in trouble. And in a COVID-19 environment, this is how likely your ratios are going to look like. And now you see, my brother, this is actually the beauty of accounting. You see, this is a number. Now you go and ask management, hey, why are we looking like this? Then they'll say, you see, we had a lot of stock that we couldn't sell. And now that makes business sense, but it came all the way from a number. So this is just not, look, at this level, the idea is not just for you to be able to number crunch. The idea is to, can you actually provide a narrative around the numbers that is, convincing for somebody to listen to you with that enthusiasm that this person speaks sense and I can be able to make a decision based on. Remember, the whole idea of us producing this set of numbers is to enable, I think the objective, I think we need to capture this here. The objective of us providing this set of numbers to outsiders is to do what? To enable external users to make economic, in fact, before we even get there, to make sound economic decisions. Now here down here, we're not enabling except we're enabling internal users.
Yeah.
Internal users to make business decisions. That's the difference.
Okay.
Do you see how important it is to actually start this
Yes.
from the two disciplines? Because
Yes.
that we've got different targets in terms of the audiences. Depending on what we do, we're still busy with the financial accounting, and this is what we're saying would be covered by this. Now, the other thing that we can also do in the form of ratios is CCC, and this is the cash conversion cycle. So in other words, how quickly do we, obviously from the day that we buy stuff, we buy stuff, inventory days, then we actually have to go and wait for people to pay us, and we call it a debtor days. But then we also have to pay our current liabilities. So this is actually the period that it takes from the day that you buy stock and then you sell it on credit, and the day that you collect the money, ultimately having to pay your creditors. How long is that whole cycle? From date of getting stock, selling on credit, therefore debtor days, and then having to pay the creditors creditor days. So you want this number to be shorter. So in other words, if this was, let's say 120, now it's 120 days, and then it was 150, we are doing great. So in other words, but you must be very worried if you are selling perishable goods, and this is how it's looking. In fact, you should be looking at some 30 to some 20 days if you are in the perishable good space. But as to whether a number is good or bad, you now need to contextualize it. In other words, look at what is the nature of the business, because depending on what you're selling, 120 days might not be a bad idea if you're selling those big machines next to the airport. So it all depends. And now you need to go and check, how are my peers doing? Because this is your year-on-year comparison, but then you need to go back and say, how are my peers doing? If it's 20, then you are in serious trouble. You are in trouble because you're doing 100 days more than what you should actually be doing compared to your peers, and that's not great. You might be improving. You see, you're commenting on all ratios, my brother. You're commenting on two levels: one, year on year; two, peer to peer. So you're comparing yourself to peers, and then that's how you maximize your marks. That's very, very important. So don't lose sight of that, and we're going to actually constantly remind you in terms of what we need to do. And my brother, that is the financial discipline. We're going to be doing a whole host of ratio analysis depending on who is the target recipient of our analysis. If it's government, then there'll be something to do with tax. If it's lenders, there'll be something to the effect of interest cover, your leverage, debt to equity, and all of that. But if it's employees, they might be comparing year-on-year profitability to say, will you be sustainable? Will you be around? Because I don't want to apply for employment in a company that will liquidate tomorrow. If it's shareholders, then we will have a set of what we call investor ratios. And such ratios will then enable the investor or the potential investor to make a decision. Because remember, with investors or shareholders, if it's a potential investor, this is a person who is deciding whether to invest or not in a company. If it's an existing shareholder, these people then will be deciding whether to sell off their shares or to, stay in the company. So you just need to be flexible in terms of who is actually asking for this information, and then you customize it specifically to then deal with the needs of the specific, target recipient of your analysis. Then you are actually good to go. And this is how you're going to decorate your land. This whole thing here. But we're not done. The statement, remember, we are on statement number 3 now. This is statement number 3. So let's do statement number 4. Let's do statement number 4, which is the last statement as far as the financial accounting is concerned. This is what we call a cash flow statement. And it's divided into what I call OIFI. Don't worry, you get all sorts of acronyms from me. OIFI.
Okay.
So basically, this is cash
flow
from cash flows from operating activities. And then you will then have, let's just copy this and we'll change the suffix. Cash flows from investing activities. Investing. So investing activities has to do with buying of assets because you are investing in the infrastructure, buying and selling of assets. Then whatever movement in the selling and the buying of assets, fixed assets will then come in this space. Then finally we have, okay, we have cash flows from financing activities. Oops, I just need to remove financing. So there's your OIFI there. That's the O there, capital letter. Let's just make it bold.
Yeah.
And then
Investing activities.
And the fee, that's OIFI. Now, if you don't want to bore a 4-year-old who's aspiring to be an accountant one day and they're asking you, what on earth is the cash flow statement? You just need to actually tell them, listen, you need to go and find money before you run a business. That, therefore, this is the financing space. Yeah. Where do we get money from? Usually, there are only two sources of getting money, and that is debt and equity. In other words, you either go and borrow money from people or you bring some of it in. Now that you have the money, the question is, what on earth do you do with the money? You then go and set up the infrastructure by buying the assets. You see what's happening here?
Yeah.
So you get the money. Now that you have the money, logically, you need to go and invest in setting up the infrastructure. Some of the money that is left, then you run the operations. Do you see how easy it is to actually understand what is the cash flow trying to do for us? It's a bottom-up approach. You read this thing bottom-up, and you'll see that, you know, these two disciplines that I shared with you, financial accounting and management accounting, they are not divorced from each other. Why? It's accounting, it's accounting. And you know what is interesting about these two disciplines? They are actually applicable to every company, and a company will have one accounting system or a CRM that they use to manage their day-to-day activities. The same system, chartered accountants will go and draw information to come up with annual financial statements. Guess what? Management accountants will go to the same system for the same set of numbers, but then just customize the information to come out with management accounts to give managers an opportunity to make sound decisions in terms of what they're doing internally. So you'll have a one SAP system or Oracle, for example. But then a management accountant will go into the same space to draw the information, customize it to come up with management accounts. The same system will then be used by a chartered accountant to come up with the annual financial statements. It's just a question of who is the target recipient. But then so far we've dealt with the financial accounting, and this is the last statement that we're looking at. Do you have any question up until here?
No, so far so good. You've like broken it down, like, you know, where you've made it straightforward. You covering almost like, you know, you've put it in a layman's language, if I can put it that way.
Thank you. So this is basically, now we can actually, in terms of our scope of what we intended to do today, we can tick that this is now green.
Yes.
Now we need to deal with this part.
Okay.
The management accounting part. I'm going to open a separate tab for you. I'm just waiting for my screen. It's frozen here. Okay, now here we go. So I'm going to open a different tab here and just rename it management accounting. So management accounting, remember I said to you that these disciplines are not divorced from each other. Now, we remember we had this balance sheet that was going like assets equals to equity plus liabilities, right?
Yes.
Now we are saying, management accountants say, you guys are are looking at this thing this way. We don't quite like how you're looking at it, but we'll adapt this information to suit our own needs. And by the way, what is the big buzzword here? Let's just capture it under financial accounting. What is the criticism against financial accounting? It is backward looking and therefore historical.
Okay.
And therefore, because we are making decisions about the future, decisions are future orientated. This is the reason why then the drawbacks or disadvantages of financial accounting led to the establishment of a different discipline called management accounting, because these guys are trying to focus what is likely to happen in the future. And by the way, in your exam itself, 60% of the questions will actually be coming from management accounting, because this one over here is actually backward looking and therefore not ideal for decision making for future orientated stuff. So I just put a big H there to say it's a historical. This one is actually forward looking, and therefore I'm going to put yes, and it's actually ideal for analysis that are geared towards the future. That's the reason why we have to then adapt what they're using here to actually then give us something that looks totally different. And we're going to say, okay, fine. These guys are saying on the one side, because remember, this is like a math equation. Left-hand side assets equals to equities plus liabilities. But then the management accountants are coming and say, look, you are making a financial decision on the left-hand side. Yeah? Okay, so I'm just going to block these things nicely. And then they then come and say, on the right-hand side, then you have to then do what? Make an investing decision.
Okay.
Investing discussion. Yeah. So this is basically what you are doing here in terms of what we are looking at. Now, we can do spell checks in Word. When you're in Excel, unfortunately, you don't have that luxury.
Yeah.
So you have to just stick to, okay. So this is now this two sides of the coin, or from a management accounting perspective. Yeah. So we're gonna put this, say, versus.
Yeah.
So these guys are saying, okay, right. This is where the money is coming from. That's why if you pick up any textbook in management accounting, they'll tell you that you should not make any financing decision in isolation from investing decision, because once you get the money, you need to know where to plug it in. You get the money and then what you put it in. What do you do with it? So where do you get the money from in the first place? You get it from debt or equity. So in other words, the financial accountants are not necessarily disagreeing with the management accountants. The management accountants are changing the look and feel. Look what is happening here. Debt is called liabilities in financial accounting. But in management accounting, we call any external source of funding debt. And then equity is equity both ways. Do you see?
Okay. Yes.
Exactly. So then the management accountants, they then say, okay, we will call this total capital, because this is where we get the money from. This is capital that we want to run the business. If you want to run a business, you must go get capital. So therefore they're saying, okay, go get capital from either debt or equity, and then we will just call this total capital that you now have. Now, let's move to the other side. Now they say, now that you have the money, you can't just have the money and then sit on it. You must go buy assets, and they call this, you're setting up the infrastructure, non-current assets. With some money that is left, you will then obviously then run the show. And we call that working capital. Remember, in accounting, financial accounting, we're calling it operations.
Yes.
This side they're saying is working capital. And this is the relationship between current assets minus current liabilities.
Okay.
Isn't this what we did when we're doing these ratios here?
Yes.
We're looking at current assets, but the management accountants are just saying, no, we just don't like your terminology. We'll introduce our own because we want to look unique.
Yeah.
And then the whole thing will give us the total enterprise value. Because if you take the infrastructure, now you've got assets and buildings, and then now the moment you're talking working capital, you're putting employees into the business itself. So now that's now the whole business. You have the infrastructure and the operations. The combination of that gives us what? The total enterprise value.
Okay.
So you have the money coming from these two sources, and then that side, then you have the infrastructure setup, and then you run the operations. The combination of the infrastructure and the operations, that's what gives you the total enterprise value. That's the TEV.
Okay.
Now, the other thing that you then start doing is to say, okay, guys, nobody gives you money for free. And this is where marks come from for the purpose of your exam.
Yeah.
And you might have heard of the concept of weighted average cost of capital, and this is where it begins. The reason why we started here is to show you that you need money, and this is where you can get your money from, but nobody gives you money for free. Debt costs you money, and you saw here that when you have this loan here, it will lead to interest here.
Yeah.
So let's give it an ugly color because interest is not a good thing. We'll give it that color. The reason why, remember, this is the fruit. When you see interest in the income statement, you expect to see a loan because the tree, this is the tree. This is the tree here.
Yeah.
Let's get the tree here. This is the tree. This is the source of that interest.
Okay,
yes.
sorry,
Of the interest.
Yes.
So you have the tree here. You have this tree here, and then this is the fruit. So management accountants are just saying, no, don't come up with some complicated stuff here. We will just say cost of debt is KD. It's equal to, now they're giving it a formula to say it's R multiplied by 1 minus T. And now let's dissect this formula here. So in Afrikaans, I don't know, did you do Afrikaans in school?
No, I didn't do it.
Okay. So perhaps just to save you from misery, let's remove that because some textbook will actually call it an I. An I is just to say the cost associated with debt is interest. But don't be surprised, in some textbook you will find that I is actually replaced by an R. But you can also relate to this. So, and you will never forget this because think about it this way. If you're going to rent property from a landlord, what do you pay them?
Rent.
You pay them rent. And you're paying them rent because you borrowed the use of the property. So similarly, when you get a loan from a bank, you are borrowing the use of the money. And therefore, in Afrikaans, interest is called rente.
Oh,
that is why, yes, that's where the R
okay.
is actually coming from. So don't be surprised. We're going to use I and R interchangeably. One day when we wake up from the other side of the bed, we'll say it's R, and the other day we'll say it's I. But I is actually just to say it's the interest cost. Now, going further with this formula here, we're saying because as a businessman, when you actually borrow money from the bank, government gives you the tax deduction. Do you see that you deduct this tax, the interest before you pay the 4,000 here in tax?
Yes.
So if you didn't have this interest here, you're going to pay tax on what? 545, 500.
Yes.
But because of the interest deduction, you are paying tax on 543.
Yes.
Because you say 545, 500 minus 2.5 is 543,000, and therefore you only pay tax on the 543 because you knock off the interest before you pay the tax. Do you see that?
Yes.
So from a business perspective, therefore, debt is cheap. Why? Because it enables you to deduct interest before you pay the government. So if you want to pay, if you want to pay government less money, make sure you have a loan. And then you pay interest, and then only then you pay the government. That's why, and it's one way for government to say, by the way, guys, what is the challenge for government in this country? Is UP, unemployment, poverty, and inequality. So by running a business, remember, you're going to employ people, and then you're helping them to deal with this headache. So they're giving you the benefit to say, you know what, kudos on you for running a business. We'll then give you a benefit from a tax perspective. Before you pay us, pay the banks.
Yeah.
And this is the reason why you will see the management accountants will then interpret this whole analysis differently by saying, okay, then we'll say, actually, if ABSA charges you 10% as interest rate, you're not actually paying 10% because you get this as a tax deduction before you get the interest as a tax deduction before you pay the tax here. Then there's a tax shield. That's a big word that you need to save somewhere.
Okay.
Debt is cheap. Debt is cheap because it enables you to deduct the interest and even the capital repayment of the loan before you actually pay. Therefore, it shields you from tax by enabling you to deduct those repayments before you pay. That's why it is 1 minus T. So this formula is loaded here. This formula, there's a story here. So now let's do this thing practically and it will come to you. We're going to say 10%, for example, is the interest rate that the bank charges you. But then we'll say, in terms of this formula, we'll multiply by, in brackets, 1 minus T. What is the tax rate for companies? 28%, for example. Then we're going to say minus 28%. Now look at this. You're going to say 10% is the follow-up, multiply by. What is 1 minus 28%? It's going to be 0.72.
Yeah.
Because you are saying you're not paying this 28%, you are saving from a tax perspective as far as the cost of debt is concerned, and therefore it's 0.72 here. Now, basically, at the end of the day, you are paying effectively 7.2%. Do you see that because of the tax benefit, you're not paying 10% to the bank, you're only paying 7.2% because you are actually getting this tax deduction in the form of interest there. And we are saying that the cost of money is interest, and therefore, this is why they always say in MBA classes or PGD classes, they'll say, if you want to be rich or wealthy, you must run businesses and stop working, because you working, you pay up to 45% in personal tax, but companies only pay a flat rate of 28%. Why? Because government is saying, thank you for running businesses and getting a pay slip, but we just call it an income statement in the form of a statement of change, profit or loss and other comprehensive income. You're helping us to solve the unemployment headache. We will not charge you exorbitant tax rates. We'll charge you 28%, and therefore you will save on tax and business pay, on the interest by deducting the interest before you pay your tax at 28%. Can you see what is happening here?
Yeah.
Now, this is the cost of debt so far. So far, so good. Let's just cross-reference this here. I'm going to do that, capital R, and I'm just going to start using WebDings now. WebDings. See, that is the reference there. It's coming down here. Capital R, and then we'll just do WebDings. Things. So that is basically there, down there. You see that there?
Yeah.
Perfect. And then on just beneath that, let's do the cost of equity there. T. So let's do WebDings. Okay. So that is a small t. Then the cost of equity, KE. So the K stands for cost in management and accounting. So in terms of the cost of debt, we say this is going to be equal to, it depends. Of equity, then we say it depends. So what does it depend on? On the info. It depends on the information provided, the scenario. So it depends on the information that is given to you in this scenario. If info relating to government bonds is given. Asset pricing model CAPM formula to calculate cost of equity as follows. Then KE is going to be equals to K risk-free, which is usually the interest rate associated with government bonds. And the reason why we're saying government bonds are risk-free is because we are asking the question, what is the likelihood that a government will fail? Almost close to zero. Of course, now
Yes.
after Iwapala, we're not sure, but under normal circumstances,
Yeah.
We don't expect governments to fail, which is why any interest rate associated with government bond is considered to be risk-free. Almost nothing is risk-free, like absolutely, but when it comes to government bonds, they're almost close to that kind of space. So K risk-free plus beta. By the way, beta is not. This is not the right sign for beta. Beta is it's got some tail. But for the purpose of this, we will actually use that. I just don't want to go to Google, get it, and then it's going to take forever. So then into K market minus K risk free. So this is basically how you calculate the cost of equity, bearing in mind that K market minus K risk-free. K risk-free is also what is referred to as the market risk premium. So if the examiner gives you the market risk premium, you're no longer going to take K market. In other words, the risk associated with the entire market minus the government bond. Now, Douglas, this is very easy, my brother, to understand because, I mean, think about it. What we're saying is the cost of equity is the risk-free associated with government bond plus the beta, which is the risk indicator of an instrument. Now you taking the risk of the whole market. Now take out what is considered not to be risky. Then you are left with the risk associated with the basically this is the premium you are paying. So because this is the whole market minus what is not considered to be risky, and what you are left with is what we call MRP. So sometimes in the exam, the examiner can give you this MRP. You need to substitute that there. You're no longer going to take K market minus K risk free. You're taking the MRP entirely, just multiply by beta. And obviously you're following BOTMAS rules here. You must first multiply this whole thing here before you can add that risk free there. That's basically how it works. Yeah. So you take that minus that, it gives you market risk premium. If market risk premium is given to you, you're not going to find K market, because that is just a substituting all of that. So I'm going to make this members of the same family here just to make life easier. So let's do that. We can use any color here.
Okay.
That, if given a market risk premium, you substitute the whole thing with that is equal to that. So just look out for this stuff in the scenario itself. Now we're saying this is if information relating to government bonds is given. If information relating to dividends is given now, let's change tag. Dividends. Dividends is given. Then you are going to use not CAPM, you're going to use GGM, Gordon growth formulae to calculate the cost of equity as follows. Now, this one says, if information relating to dividends is given, we're going to say KE is equal to D1 divided by P naught G, small g. This is if information relating to dividends is given in this scenario. Now let's dissect this one further. What is D1? D1 is equal to D naught plus G. So what on earth is D naught then? D naught is current year dividend. And how it's going to be worded is the examiner will say the company just paid a dividend of XYZ of like that, right? And then you know that this is actually D naught. G is what we call sustainable growth rate, SGR, or sometimes constant growth rate. So in other words, by how much we expect this company to grow by into the future, because you're buying into long-term sustainability of the business. So now this D naught here is the current year dividend, but you need to grow it. But the moment you bring in growth is only going to happen in the future. Therefore, that's how you get to D1. Let's say, for example, I tell you that I just paid a dividend of 8 Rand, but then I expect this to grow by 6%. Now the question is, what is D1? You're going to actually simply take your 8, multiply it by 1.06, because you're growing it by 6%. Therefore, your future dividend is going to be 8.40 Rand, and that's what you're going to replace there in terms of your formula. So as to whether you're using CAPM or Gordon growth model, these are the two buzzwords here. Let's just highlight them. Okay. So for that one, GGM. So this is what you really need to make a big fat note of. And when we're doing calculations, I'll constantly remind you that, by the way, this is in terms of CAPM or GGM. Depending on what information is given in the scenario, then you can decide what actually would work. Now, this is basically just us calculating the cost of debt and equity. Now that we know how to calculate the cost of debt and equity, remember, the objective has always been to calculate what? Weighted average cost of capital. So now what you need to understand is this is that you would need to generate from any project that you invest in to be able to pay back the cost of debt and equity. Because remember, I said to you that money cost, there is a cost associated with the money that you get from debt holders and equity holders. Now, if hypothetically speaking, if your work is 15%, for example, what does this mean? It means any project that you're going to invest in must give you a return that far exceeds the 15%. Why? Because if you get a project that yields a return of 15%, what does that mean? You are only generating enough return to be able to pay back your equity holders and your debt holders and remain with what? Nothing. And therefore, you will not be creating shareholder value by generating a return that is equivalent to work, because then it means you don't have anything left in your pocket. This is to say, basically, you are break-evening in terms of the BEP analysis or sensitivity analysis that you did in terms of break-even point. So the weighted average cost of capital is the cost of money arising from the fact that we borrow from, we get money from debt holders, and some of it we bring it in. Because why do we say equity cost money? Because these guys, equity holders, want dividends. These guys at the bottom here, we said we're making a doctored decision. We need to decide, are we distributing or are we retaining? And therefore, money is not free. And how we calculate the cost associated with it depends on what the information is given to us. But what we're saying is, ultimately, we are looking to calculate weighted average cost of capital with all of these things that we've been doing up until now. Why? Because we want to evaluate the investment opportunities. And this goes back to your economics lessons to say, what is the main economic problem in everybody's life? And even at a macro level, countries don't have bottomless pockets. In other words, we need to really be able to conduct due diligence. If you were to ask me what led to this, a technique called weighted average cost of capital, it came out of economics, because economics says you've got unlimited wants but limited resources, therefore scarcity. So we've got 110 million Rand on the table, but we can invest it in anything. So how do we decide which opportunity to plug that 10 million Rand in? We need need to then say, guys, okay, this is our benchmark. This is how much the cost of this, because we've got this 10 million rand now. But the question is, where did it come from? Some of it came from equity, some of it came from loans or debt. Then we need to make sure that by the time we say, this is the project we're going to invest in, it's going to yield a return that far exceeds the cost associated with the debt and the equity cost combined. So this is what we call weighted average cost of capital. So now, whatever return we get, we need to be getting some, 17%. Why? Because we now need to say, okay, but what is our true return then? If we're getting 17%, then we have to pay 15%. Essentially, this is our net return coming straight to us. This is like your actual, return that's going to be in your pocket. So I'm going to show you how to consistently, and this is the table that I've recommended to the guys, that do not chop and change how you calculate the weighted average cost of capital, because your brain is going to actually freeze, because you need to be consistent and help it to remember how you actually get to the answer all the time in a consistent manner without chopping and changing this whole thing. So here's the table that you need to remember, my brother. It's always going to have 5 columns. How many columns do we have here? 1, 2, 3, 4. So this is basically the table that you will use all the time, not sometimes, all the time. As long as it's a work calculation, you need to come back here. I always want to see you drawing this all the time, because it will help your brain to, process this thing. So the first thing that we need here is the component. What component, where did we get our money from? What is the source of funds? Yeah. And then we put in here the amount. And by the way, the key word here is market values. Why do you think we're using market values here? Because market values, it says to us, this is the values at which you can actually raise a loan right now in the market, and therefore forward looking. And therefore, remember, what is the criticism for financial accountants? We have a loan here, we have equity, but are we going to use these numbers? We're not going to use the million rand. We're not necessarily going to use the 200,000. Why? Because this is historical data. It's looking at the past 12 months, and management accountants are looking into the future. And therefore, we need to use market values, because market values are pointing to the sentiments in the market and therefore future orientated. Did you get that?
Yes.
So the examiner is going to give you the set of numbers that have equity, but are you going to use them, the million rand? Never. You're going to use this as a guideline for you to actually see basically what should be the market value of the equity. So what questions you're going to be asking is, let's say, for example, these were some 100 shares issued. And then how do we get to 1 million from 100,000 shares? We must have sold them at 100 rand. Yeah.
Yeah.
But when we come to management accounting, the same information, remember, you need this information, but you don't need this 1 million rand. What information do you need? You need that. So I'm going to make a big fat note here for you to say, man accounting, you're going to need this information at a later stage. Why? Because the examiner is going to then tell you in management accounting that the share price right now, they'll say the share price. So they will say current share price, CPS. Current share price is 124 rand. So 124 rand. So what are you supposed to do? Let's put a rand value there to show that it's money. So how do you get market value? Because they're telling you each share is 124. But you know how many shares have been issued? 100,000. So therefore, for management accounting purposes, we're going to say, remember our components here, we're going to say is debt. And what is the other one? It's always going to be equity. But exactly. So here we're going to say, okay, thank you, financial accountants, for telling us that we had issued 100,000 shares. When you make use of the number, but not quite everything that you guys do, because it's historical. We're going to take your 100,000, thank you very much, but then we'll multiply it by what? 24. Sorry, 124. 124. Therefore, currently, when you issued these shares previously, they were able to raise, let's just put this in. Yeah. It's 124 rand. Also, then something is not like at the same. If 100,000 shares, okay, so how do we get to, let's just do this. 1 million rand equals to 1 million rand. 1 million divided by 100,000. How much do we get?
10,000.
10,000 shares. Okay, that's fine. So we issued 10,000 shares, and then we raised, because we were selling them at the time at 100. Therefore, that's how we get to 1 million. Let's just test this. Equals to 10,000 shares at. Yes, that's 1 million rand. That's fine. Fantastic. So thank you very much for giving us that information. But all we need is to actually understand that we had 10,000 shares issued, but they are right now worth 124 each, because we sold them at 100 at the time. They are now at 124 because we are saying market values. We can't use this million rand. And by the way, the one thing that we need to make a big fat note of is this 1,240,000 after taking the 10,000 shares multiplied by 124 does not only represent share capital, it represents the entire equity. In other words, it's a representation of share capital and retained earnings from a management accounting perspective, because the market value, it's holistic, it's all encompassing this thing. Exactly. Now, debt, now we go back to the balance sheet and say, do you think we can actually use, and again, do we use 35 plus 500,000, or do we only use 500,000? What do you think? We're supposed to only use 500,000. Why? Because these are long term.
Yeah.
Because remember, we are investing far into the future. You never, ever include current liabilities, because they are not part of the capital structure in terms of debt. It's only going to be long term. Do you think we can use this 500,000 even though we are saying it's historical? Yes, because the chances are the cost, the value of a debt or a long-term debt is exactly what you will get from a bank. This doesn't fluctuate as such. But equity is driven by sentiments. The markets go up and down and all of that, which is why we need to consider the current situation. Now, with debt, we can gladly go and say, financial accountants, for once, we agree with you, 500,000. Yeah. So this is basically what your instruments or the components are going to look like. And therefore, because we're looking for total, then it's going to be that number plus that number. But before we carry on, let's just complete this. This is going to be amount, and then we do the weight, and then we do the cost. Right, and then we have our weighted average cost of capital there. Now, so this is total capital here, because we say debt plus equity gives us a total capital, and then this two here added together, that's how we get to, by the way, this is now the final number. So let's just put it in underline it like that, so that then we can see. The weight is to say, to what extent did we finance our structure through debt? So we're going to take 500,000, but it is out of a total of a pool of 1.7 million. Therefore, this tells us that to an extent of 29%, this is actually funded through debt. This company is funded through debt to the tune of 29%. Therefore, it's not necessary. Do you really need to calculate this one? No, because you know that the two, in other words, debt and equity, even in terms of percentage, is supposed to be 100%. So if you have 29 here, what is missing here? It's basically going to be some, let's see, 71-ish. Yeah. So this is going to be, 1 minus that number, 71%. So the examiner is not going to give you, by the way, they will say the debt to equity ratio is equal to 60%.
Okay.
You see how they're going to give it to you. So you know that debt is 60%, then you plug in 60% there, then the 40% automatically will be equity. So this is how they're going to give it to you in the exam. Just if you don't have this market values, they'll give you a target, and that's what you're going to. So if you have a target like this, you don't need this amount because they've already done this for you. You only need this to calculate that.
Okay.
Now, assuming that we've actually gone through this trouble of calculating the cost of debt here, and we have 7.2%, so this will be then 7.2%. And then assuming that we've gone and calculated the cost of equity, we will then obviously have to say, let's assume there is a number here. We come out with, say, 8.5%. Now, you can't add this to because these are separate, unique costs associated with debt and equity. This is a combination, to say total capital is a combination of debt and equity. That's why we have 100% here in terms of percentage split. So this is probably going to be a family type of business because you can see they want to keep it in the family. Do you see that?
Yeah.
Yeah, it's like equity holders are the guys that are, the last to be paid. So they're not overexposed in terms of, debt funding and all of that. So you can clearly see, without necessarily even reading the name of the company to say, is it a PTY? You can almost expect this to be a PTY because there's more of, equity holders holding a bigger portion of the funding structure. Yeah. And then now, because we're saying this is the weight, this is the cost, and we're looking for the weighted average cost of capital, then I'm going to do something here that will actually help you remember. So you multiply that by the cost, and then you're going to then get that answer, which is weight multiplied by the cost, you get the weighted average cost of capital. Do you see how it works?
Yes.
Then therefore, to get these, you're going to say 29% multiplied by that number there. Therefore, this is the percentage that you're actually going to get. I just need to format it. Let's get that. It's 2.07%. So we pretty much do the same for the next one. Then it's 6%. Then in total, because we are looking for the total cost of our debt and equity instrument holders, then it's going to be that number plus that number. Then you get 8%. In other words, any project that is going to deliver less than 8%, it means we're going to be in a loss-making position. We won't even be able to pay our debt and equity holders because they are asking for 2.07%. These ones are asking for 6.06%. And in total, then we have a cost to deal with of 8.13%. So this helps you to evaluate projects to say any project that is not likely to deliver anything beyond 8.13% is going to be a waste of our money because it's going to result in a negative return and therefore destroy shareholder value. So you will use this to decide which project is actually going to be profitable for you before you even invest. Because remember, our biggest thing here is to make sure that we make a decision to invest in projects that will yield a meaningful return for us and then help us to create shareholder value as opposed to destroying it. So this is basically, my brother, how you're going to calculate the weighted average cost of capital. But not only will you use WACC to actually evaluate projects, you are going to use other project evaluation techniques. And remember the danger of a single story. We're going to use multiple project evaluation techniques to point out which project is actually going to be profitable. And what are some of those? We're going to do NPV calculation. You will need WACC to calculate NPV. We are going to calculate payback period. Payback period. You will obviously need work to discount the cash flows. And then you are also going to do profitability index. You are also going to do internal rate of return. All of these project evaluation techniques that I'm just going to box now, all of this is a feasibility study techniques that you're going to use. It's due diligence, project evaluation techniques, whatever you want to call them. It's a feasibility, whatever study to decide which one or which project would actually then yield a positive return. So all of these things really here, they are actually pointing to the fact that you need to be judicious. In other words, you need to make sure that you invest after doing your homework in simple terms. And how do you do that? You first need to know what is the cost of money. Once you have established this, any project that yields a return that is less than this, you're not interested because your benchmark or your break even or your negotiation starting point is, guys, I have to pay my debt and equity holders 8.1%. So if you're going to be giving me anything that is less than this, I'm not interested because I'm not going to be making money from this thing, then it's not worth my while. So that is essentially what you're doing with all of this. So now we've transitioned from financial accounting, depending on your target audience there. Now we've switched gear to this. We are here where we say there are also manner of calculations that we're going to do. But first things first, we need to understand that all we are doing, we are making financing decisions with investing decisions. So far, we've dealt with this side of the equation.
We're saying there's no one who will give you money for free. There will be a cost. How do you calculate the cost of money? This is how we do it in terms of cost of debt. But the cost of equity, it all depends on the information that is given to you. If there's something to the effect of government bonds, you can only use CAPEP, capital asset pricing model, where we're saying KE, or the cost of equity, is equal to K risk free plus beta into K market minus K risk free. But sometimes the examiner just want to make your life easier. They'll give you MRP. Then you substitute all of this in brackets here with that one number, and then you carry on with the formula. And then whatever number that you get from here as the cost of equity is going to filter through all the way here as the cost of equity here. And then the weight is obviously informed by this divided by the total. And then you go back and calculate the cost of if you are given dividends in this way, and the number that you get here again will then substitute that. And once you're done with this cost and you have the weighting, remember, is either you use this amount to calculate the weight, or if a target is given, you just substitute it here, and then there will be nothing here if a target is given, because you're going to substitute that there, and then you're good to go to calculate the cost of capital, which is the weight multiplied by the cost, and then that's how you get to the weighted average cost of capital. And then you use this number, use work to evaluate or to basically perform analysis. Perform all sorts of analysis will come from this. Project evaluation, discounting of cash flows, everything is going to be around work. So where the examiner wants you to do the discounting of cash flows, they will give you the work. But where they want you to calculate the work, then they will not necessarily expect you to do the discounting of the cash flows. It's either or, because the whole point is to test one principle at a time. And I think once you get that technique out of the way, you then know how this exam is going to pan out. And then, my brother, this is what I've actually shared with the guys as a background to ease them into the space before we start doing complicated stuff. But I constantly then remind them that, guys, this calculation that we're doing is a short calculation, but this is how it fits into the biggest, the big scheme of things. Because I don't want them to just not have a bigger picture, and we jump straight into number crunching, because then they'll be asking me, Joseph, but why? Then I'll be saying, now we're wearing our financial accounting hat, and this is this hat here. Now we're wearing our management accounting hat, and that is that hat there. And then we can go back and say, guys, this is the discipline called corporate finance. It's encompassing both disciplines, and this is basically how it works. Okay. That is the story for day one. Okay. But it's actually just an entry into, you know, the complicated space. Not complicated, it's a very nice space to actually be in, because when we're doing those calculations on Saturday or Sunday, depending on, or they said Saturday, I'll just check with the other guys. Then it will be based on these principles that I shared with you today, this morning, and you just need to obviously go back, you know, watch this video again, and I'm gonna also just put it on the group, and the guys can actually. Unfortunately, I'm going to send it via WeTransfer. It's going to expire, so I think it gives you something like 10 days or something. I'll just wait for it to download. You should get this before 4 today, and I'll send it your way, and then just put it on the group and then download it, go through it, try and understand exactly what we've covered, because come tomorrow, we're going to be referencing this learnings, and then it will just be a continuation. I don't want you to feel like you are not on the same, you know, page in terms of what we're doing. And I'll constantly revert back to the principle, just parts of them, depending on what we are entertaining at any given point in time.
All right. Okay. All right.
Douglas, I know we didn't even take a break. Yeah.
No, it's fine. It's fine.
Yeah.
It's fine. It's fine.
We pushed right through.
No, thank you so much.
Yeah.
This is great. Like now it's you know, it's stitching together. So thank you so much. Yeah.
Good. Brother, no problem. And let's wait for the guys to confirm what time we're meeting tomorrow. That is if we are meeting, but I would suggest strongly that we push for a meeting, because look, my next 2 weeks are going to be crazy. I might not be able to meet, so the sooner the better.
Okay.
Good stuff.
No,
good
all
stuff.
right. Okay, cool.
No problem,
thank you so much.
Take care, man. We'll chat soon. Take care.
You too. All right.
Cheers, man. Bye.
Cheers.